let's look at the Dow Jones ETF. First off, read this disclaimer carefully. So, we are looking at the SPDR Dow Jones Industrial Average ETF. DIA is the ticker. So this is, it gives us quite a bit of history. We go all the way back here to 1998. So we do get the dot-com bubble. And also the financial crisis. So let's look at some history. So here you have the dot-com bubble, and you can see that even during that bear market, which from the high here to the low, that was minus 37%. Throughout that bear market, there were quite a few of these rallies. Here we have a rather impressive rally, 28%. So this looked like a new bull market. However, we went up into resistance levels, and then we fell very hard. You could also make the case that we have a head and shoulders pattern here. Here we have what seems like a V-shaped recovery, then we have a double top, and then we crash. So that was that bear market. Big rallies and big crashes throughout. Then we go here to the financial crisis. So if we measure from the high to the low, minus 53-ish%, but here we had a rather substantial rally, which amounted to 10%. So this seemed like an attempted recovery. We meet resistance here at the 50-week moving average, and then we crash very, very hard. So that's another example of how, things can go awry. Something you will probably notice is that this was a much more orderly bear market. This was way more aggressive. Let's zoom into our current situation. Well, this looks a whole lot worse. You could make a lot of cases for this. I definitively think that the use of technology contributes to these really aggressive sell-offs. There is also more advanced instruments that can be used to also profit during a plunge. Hence, the selling pressure, when it comes, it can be really, really, really fierce. Before this big crash, we did have a double top. You could certainly make that case. And this is our current situation. We are testing this blue 5-week moving average. That's a key critical level on the weekly data points. If we go here to the daily data points, there are other key levels. You have, especially in this case, the 20-day moving average. It's currently forming a solid resistance level. Even today, we went up to test it, but then were rejected. We are currently finding support at the blue 5-day moving average. So as you can see here, price is getting squeezed between a resistance level and a support level. So something has to give. We closed at the low here, resting on the 5-day moving average. So this is an incredibly critical situation for the market. This is recorded right after market close on the 31st of March. So the big issue is that a lot of payments are due for the end of the month, or the first day of the next month, like the 1st of April. And if we do see that many people are not able to pay those bills, that would certainly spark more selling pressure, and we are in a vulnerable position. You also here, from a technical standpoint, have the death cross with the 50-day moving average crossing below the 200-day, and The 200-day is now negative, pointing downwards. That's not good. If we measure the fall from grace, from here to there, yeah, it's around a 37% plunge. So that's a rather deep bear market. So yeah, these are very rocky times. And whatever you do, of course, you always want to let the trend be your friend and definitively look at the big picture. Because as I'm suggesting, there are many variables on the horizon that are much more spooky than the virus.